First of all, do you think the dynamics of the environment is allowing a possible price hike, which select sections of the market talking about?
Certainly. I think it's not just now. I think since November onwards, or maybe December onwards, the demand has been extremely supportive of price hikes. I'm like, would be surprised as anybody else that why the price hikes could not be increased in January, February, and even March for that matter, because demand is clearly in high single digits to double digits in most of the regions.
What about valuations? Along with the market, even this space, big, small, mid, almost every name got corrected 10, 15, 20%. Even that threat of big M&A also went by and got diluted. Do you find valuation comfort? Which pocket do you find valuation comfort in, large cap or mid cap cement?
See, valuations, obviously, there is always a gap between a large cap and the mid caps. But in times like these, when the prices tend to be so much more volatile, we'll stick to large caps only, a select mid caps. I don't really want to call out across the board mid caps kind of a thing. So large cap is what I think the valuations are not still except for Shree Cement where it's extremely expensive. Other than that, I think the valuations are very much in comfort zone. And if somebody's that much more value conscious to, let's say, invest in Ultratech, then Grasim could clearly be a good bet or an alternative to that, where the holdco discount is clearly much higher than the past 4-5 years average.
But I mean, in the longer haul, where do you think value generation is going to come in from? Is it going to be an effect or other function of pricing? Or is it going to be the one with the bigger capacities which is going to win the race?
See, it's a commodity and it has to be sensitive extremely to prices. So and prices, of course, then are linked to demand and more importantly to utilizations. So you really can't, I'm saying, take that kind of a structural call given the low utilizations that they are and given the competitive intensity that we have seen in the recent past. More so, if I may say, competitive intensity despite extreme cost pressures. So now that cost is easing clearly, and demand is also an uptrend. Next year is a pre-election year again. So I think from a near-term perspective, there is definitely more upside in these frontline cement stocks for sure. But from a longer-term view, if you were to take, then I would be a little cagey to take that call.
What about the cost structures? How are you observing the margin outlook for many of these names? Because transportation is a big area for them as a cost, and crude prices have actually come down pretty reasonably.
So crude price and diesel prices in India are two completely different things, right? As in, we have seen there's no 1:1 correlation is what I'm trying to say. So despite the recent extremely sharp fall in the prices of crude, diesel prices have not really budged. So no respite from the transportation cost, but yes, from the fuel cost, which is direct imported coal or petcoke, as you guys are highlighting on the screen right now, there definitely is going to be a respite there, at least I think, if not more, 200 to 250 rupees per ton kind of a cost decline you can clearly see for companies, or by and large for the industry, from the December levels. So yes, near-term cost cushion clearly will support margin expansions.
Right. Okay, Navin, great to have you on the show. Thank you so much for highlighting what to expect really and how to play the entire cement sector going forward.